Hello and welcome to the show. I'm Kim Parlee. Thank you so much for joining us. At 107 months into the bull market, it's the second longest bull market since 1929, which has investors asking, how much longer can equity markets keep rising? And how should I position my portfolio in a late stage bull market? Here to talk about markets, risk, FOMO, fear of missing out, and other key things happening in the market. It says Brad Simpson. He is Chief Wealth Strategist in Private Wealth Management at TD Wealth. Welcome. Nice to have you here.
Nice to be here. Thanks for having me.
You are a prolific writer, and I know there's lots of pieces that you've put out since joining TD Wealth. So I've cherry-picked a few things out of what you've been writing, of some of the pictures, some of the charts, to talk a bit about what's going on.
Nice. Let's hope it's the good ones.
Let's hope. Well, here we go. So let's talk a bit about just the fact that we are 107 months into a bull market. I mean, this is something, isn't it?
Absolutely. It's something else. The average bull market since 1929 is about 42 months. So we are well above the average here.
Yeah, we have. I'm going to pull up this first chart you have here. You've got to look a couple of charts here, looking at the VIX.
Yeah.
And the plunge in volatility. If we can pull that first one up, it shows us. I think we've got the lowest yearly average in history here.
Yeah, everybody's so excited about what a great return the S&P 500 was last year, and every month was positive. But this is the real story.
Yeah.
Markets are supposed to have ups and downs, and
we only have ups right now.
We only have ups. So if you look at the sort of volatility that we saw in last year is unheard of. You're going all the way back to the early 1990s. We had 53 days of the VIX below 10.
Actually, Harold, let's bring that one up here that we show, because this picture actually just says it so well when you actually see it. That's nuts.
Yeah, there's no doubt that really sticks out at you. And to me, that's your story of 2017. And it's also the story of really a marketplace that is now so accustomed to central banks kind of pushing all the concerns away that this is at the end game. This is what this begins to look like. So
with the market accustomed to lack of volatility, accustomed to these returns, what does this mean for valuations? Again, we've got a picture here showing, I think, PEs, dividend yields. Is this an accurately priced market? I mean, what are PEs like now?
That one of the things we have to be careful of is the framing effect. Is valuations all in the eye of a beholder, and what's your starting point, and how do you look at it from there?
So just back up for 1 second. The framing effect is?
Well, framing effect is looking at the environment around you and determining what it is that you're seeing and how the impact of what that knowledge you're bringing to it is.
Yeah.
Right? So if we look at this in the terms of today, I mean, if you look at a price-earnings ratio in the 1970s, well, they were a lot lower than they were today. Mm-hmm. Interest rates were a lot higher. Mm-hmm. And, so then if we compare that to an era when interest rates are lower, like the 1990s, you start to get a picture of that, well, maybe it isn't so high. So, if we overlook at over the last couple decades, the average price-earnings ratio you're looking at about 17 times. Today, we're about 19 and a half times. Mm-hmm. That's not inexpensive. But given in the context of low interest rates, and that starts to make it much more reasonable. Mm-hmm. And I think for us, what I really want to think about is that our behavior and how we think about markets flows through everything. Low interest rates, and this is no newsflash for everybody, right? The lower in interest rates, the more you're willing to pay for a rate of return from something else. And as long as your interest rates are low and companies are growing their earnings base and having the ability to increase their dividend, you'll see a stock market to start to reflect that. So expensive, yes. But I think it's difficult to make a really long, ugly argument that markets are really expensive. They're not. They're fully valued.
One thing you talk about, I want to be clear, because the things that I have chosen from what you wrote about, I think might imply here that, that maybe the correction is coming, and you're not saying that.
No.
But I think you're
No.
highlighting some things that we're not very good at seeing
Right.
these things coming. So
Right.
let's take a look at this one here. You've
Sure.
got a look at, the size of pullbacks
Right.
when they did happen.
Right.
Are significant.
Yes.
So again, let's pull that one up, and it shows again that not many people do see these big corrections happening.
Right. Look, a fundamental belief that we have at TD Wealth is that corrections will happen, and that is the that is one of the realities of investing in equities. Mm-hmm. Now we're so used to having the story of predicting when this is going to happen. And my firm belief is that I don't think market strategists or portfolio managers or analysts are good at making predictions. I don't think that's what the business that we're in. So really what I'm talking about here is saying that just because markets have gone up for a long time doesn't mean it's inevitable. What it means is that if you look at it in a different light, you think where we came from. 10 years ago, the economy had stopped. Mm-hmm. The markets were devastated. If we was chatting 3 years ago, they're finally getting back to where they were. What a relief. Mm-hmm. This has been one of our investment themes is a long time coming. And a long time coming is to get ourselves actually to a place where markets are fully valued, where we are starting to see the benefits in an economy. And so what that chart really shows is that bull markets can go on for long periods of time. People aren't terribly good at predicting their end. And in this case, we can see why the markets are valued the way they are.
I'm here with Brad Simpson, Chief Wealth Strategist at Private Wealth Management at TD Wealth. We've been talking about just the fact that markets, of course, are in a bull rally newsflash, late-stage bull. Also looking at, the size of the pullbacks when they happen. And you also had a chart in here I thought was pretty interesting, Brad, about some of the things that are, quote, precursors to recessionary scenarios. So we're going to bring that up. And I think the one thing I remember, I looked at this and said, we don't have a lot of those on right now.
Right. No, I mean, this chart really hits home. Is that usually a recession and a bear market go hand in hand, right? You start seeing some of these froth this way. You'll see a yield curve that's inverted. We don't have that today. You see inflation. Well, we're still celebrating 200 basis points of inflation and thinking that's great.
Right. If
we were really in a robust environment, it would be 3-4%, which we're not seeing. We're not seeing wage inflation today. Labor market is really good, but it's good, but not too good.
Yeah.
And so, well, the beauty of this chart is just kind of lays out the things if you wanted to do a check mark of all the things that would lead to a recession. Well, we really don't have any of those check marks in place.
Yeah.
Right. So I think that's why this long time coming theme potentially has a little bit more to go than what you think.
Let's also talk about behavior that happens right now, because when you look at the headlines right now, and you look at the trading activity that's going on in the markets right now, I mean, there's a lot of FOMO going on, people jumping in the market because they feel like they've missed the incredible run-up that has happened. But we're also seeing things like, marijuana stocks being front and center.
Has that been a big thing?
That's been a big thing, yes. And Bitcoin, of course, even though it's been crashing in recent days, I mean, it's had a nice run. From the wealth strategist perspective, when you hear marijuana and Bitcoin, what do you think?
Well, I think a couple things to it. One, first and foremost is that it has a lot of the tenets of a craze.
Yeah.
Right. And I've been in the investment business for 27 years, and the closest one that it feels and you can see just even in your personal day to day. In the late 1990s, the tech and the internet craze, where you had little companies that with no business plan and no profitability, where they could see for maybe infinity.
Yeah.
And this incredible excitement around it, and because it was a popular culture item, it was something that you could touch and feel and see. And I think, you see a lot of that. And, I always, while I live and I work in Toronto, I'm a good West Coaster. I mean, I think I've seen this kind of thing into my bones.
Yeah.
There's there are more pot dispensaries in downtown Victoria than there are coffee shops. So it's a very real thing. But I think that, and then I think even on a more serious note on the blockchain.
Not to be confused with Bitcoin.
Not to be confused with Bitcoin. The Bitcoin, that again, another. I was riding on the up train the other day, which is the train that goes from Toronto to the airport, and there were two young guys who were talking to one another on their trading strategy of every time it went below $10,000 to take their paycheck and put it in it, and
It's concerning.
And so the only thing I would say is that there's a great chasm between the idea of investment and speculation, and speculation is always been in our culture, and what I would leave it at is to really look at it and to say that those who are speculating to know that many of the things they could be doing could end out in zero.
Let me, I've only got about a minute and a half here, and I apologize for not giving you proper time to address the most important question is, what do you do in a market like this? Because I think that's the thing. I know that you work with a lot of high net worth people in terms of helping them figure out the proper allocation. It's not the traditional allocation. I think it talks about in terms of fixed and equities. Right. It's what?
Right. Well, I think that I would hit home in a market like this is two things. One, I think you want to have a portfolio that is diversified beyond your traditional exposures. I think, you look at what pensions and endowments do, who have a longer-term time horizon. You have your stocks and your bonds, but you can also have some private equity and some private debt, and maybe some investments that are hedging volatility, hedging risks, things that are
counter-cyclical.
So if you have a bit of a part of your portfolio going down, you actually have a part of your portfolio that is actually staying still because it's benefiting from it going down.
But is there a concern, I guess, with everything having been going up? I mean, bonds have changed, obviously, but people aren't thinking like that right now. Are you getting a bit of that?
Well, I think what people aren't thinking is that on one side they've pushed the stock market to their all-time highs. The other side, how you can tell the value if you have a valuation stretched in the bond market, are spreads between a government bond and a corporate bond. They're at their all-time lows too. So I think the one thing is to say, do I have diversification between just stocks and bonds?
We're going to have to leave it there. We'll have you back, though. We've kind of scratched on a whole bunch of topics, but we've got a lot more to go. Brad, thanks very much.
Thanks for having me.
Pleasure. Brad Simpson, he is Chief Wealth Strategist at Private Wealth Management and in TD Wealth.